There are some characteristics of the stock market that some people may find concerning or difficult to understand. Here are some aspects of the stock market that some people may consider as dark secrets. Insider trading refers to the buying or selling of a company's stock or securities by someone who has access to confidential or non-public information about the company. This information could give that person an unfair advantage in the stock market. For example, imagine that you work for a company that is about to release a new product that you know will be very successful. You know this because you are involved in the development of the product and have access to information that has not yet been made public. If you were to use this information to buy shares of your company's stock before the product is released, you would be engaging in insider trading. This is because you have information that other investors do not have, which gives you an unfair advantage in the stock market. Insider trading is illegal because it can harm the fairness and integrity of the stock market. This is illegal and can lead to severe penalties. Market manipulation is an illegal practice that involves intentionally distorting the supply and demand of a particular stock or asset to influence its price. For example, imagine that you own a large number of shares in a company and want to sell them at a higher price than what they are currently worth. To do this, you might spread false rumors about the company's financial health or upcoming product releases to create a false sense of excitement about the stock. As a result, more people might start buying the stock, which would increase its demand and drive up its price. Once the price has increased to the level you want, you can then sell your shares at a profit. This type of market manipulation is illegal because it can artificially inflate the price of a stock and harm other investors who are not aware of the false information being spread. If caught, those involved in market manipulation can face significant fines, penalties, and even imprisonment. High-frequency trading, HFT, is a type of trading that uses complex algorithms and computer programs to execute trades at high speeds. HFT can potentially give an unfair advantage to those with the fastest technology and information. Imagine that you are a high-frequency trader and you have access to the latest and fastest trading technology. You use this technology to buy and sell stocks at very high speeds, sometimes executing trades in just a fraction of a second. This allows you to make quick profits on small price movements in the market. However, not all traders have access to this technology, and those who do not may be at a disadvantage when it comes to executing trades quickly. This can give high-frequency traders an unfair advantage and may lead to an uneven playing field in the stock market. High-frequency trading is a controversial practice because some people believe that it can contribute to market instability and volatility. Volatility and risk are two important aspects of stock trading that can affect an investor's financial outcomes. Volatility refers to the degree of variation in the price of a stock over a period of time. A stock with high volatility will have large price swings over a short period of time, while a stock with low volatility will have more stable and predictable price movements. For example, imagine that you invest in a stock that is known for having high volatility, such as a technology startup that is still in the early stages of development. Because the company is still new and relatively unknown, its stock price may fluctuate rapidly and unpredictably as investors try to assess its potential. Risk, on the other hand, refers to the possibility of losing money on an investment. All investments come with some level of risk, but some investments are riskier than others. For example, imagine that you invest in a small biotech company that is developing a new drug. While the potential rewards of this investment may be high if the drug is successful, there is also a significant risk that the drug will not be approved by regulators or that it will fail in clinical trials. As a result, your investment in this company is considered to be high risk. In general, investments with higher volatility tend to be riskier, as they have a greater potential for large gains or losses. Investors should carefully consider their risk tolerance and investment goals when deciding where to invest their money in the stock market. Lack of transparency in stock trading refers to a situation where investors do not have access to all of the information they need to make informed investment decisions. This can occur when companies or financial institutions do not disclose important information, or when there are conflicts of interest that make it difficult for investors to trust the information they receive. For example, imagine that a company is preparing to release its quarterly earnings report. If the company withholds information or provides misleading information about its financial performance, investors may not have an accurate picture of the company's health and may make investment decisions based on incomplete or inaccurate information. This lack of transparency can lead to market inefficiencies and can harm investors who rely on accurate information to make investment decisions. Lack of transparency can also occur in other areas of the stock market, such as with certain types of investment products or financial instruments that may be difficult to understand or have hidden fees and charges. To protect themselves from the risks associated with lack of transparency, investors should carefully research the companies and investments they are considering and seek advice from trusted financial professionals. It is important to note that not all influencers use their platforms to intentionally cause losses for investors. However, in some cases, influencers may promote certain stocks or investment products without fully understanding the risks involved or without disclosing their own financial interests. This can lead to a situation where investors make investment decisions based on incomplete or biased information, which can ultimately result in losses for those investors. One recent example of this occurred in India in early 2021, when a group of influencers on social media platform Twitter started promoting a stock called GameStop. This promotion was part of a coordinated effort by individual investors to drive up the price of GameStop stock in order to inflict losses on hedge funds who had taken short positions on the stock. While this effort was successful in causing short-term gains for some individual investors, the volatility and rapid increase in GameStop stock price ultimately led to significant losses for many investors who had bought in at the peak of the market. It is important to note that the GameStop situation was unique and not representative of how all influencers operate. However, investors should always be cautious when making investment decisions based on information they receive from influencers or social media and should carefully research and consider all factors before making any investment decisions.